Good afternoon. My name is Jim Kokolis, Managing Partner for Calibre CPA Group. I'm pleased to welcome you to our 11th Annual National Labor Union Conference. Each year, we look forward to this conference where we connect with our labor union colleagues and present a comprehensive update. Our agenda today will cover central topics such as regulatory reporting, financial matters, relevant to your organization, effective fraud risk management, and valuable insights into labor union financial compliance. We have an exceptional group of speakers presenting for you today, from some of Calibre's partners and tax director to our featured speaker, John Lund, former director of the Office of Labor Management Standards with the Department of Labor. John will share insights on best practices in labor union financial compliance. So thanks to all our speakers for dedicating the time and effort in preparing these presentations today. Before we jump into the presentations, we'd like just to provide you with an overview of how the conference is going to be conducted today. Following the sessions, we will have a Q&A session where you can submit any questions that you might have, and you can use the designated Q&A window at the bottom of your screen to type in the questions. We'll do our best to address as many questions as possible towards the end. If you are interested in earning continuing professional education or CPE credits during today's session, we have incorporated polling questions throughout the conference to ensure compliance with the applicable CPE criteria. So just make sure that you answer these questions as they arise throughout the conference. Also for the CPE after the program, you'll receive an email with instructions on accessing the program materials and requesting up to 3 hours of continuing professional education credits. So without further delay, I'll introduce our first speaker who will kick off the conference. Mary Margaret Prange, a partner in the Audit and Accounting Department of Calibre CPA Group, will be presenting on the most recent audit and accounting updates for this year, for 2023. Mary Margaret brings a lot of experience in accounting and auditing, particularly with labor organizations. Her experience includes developing and instructing multiple courses on auditing and accounting for tax-exempt organizations. Additionally, she's contributed many articles to various publications focusing on topics that impact labor unions and the not-for-profit industry. So welcome, Mary Margaret.
Thank you so much, Jim. Great to be here with everybody. I watched as folks were getting online with us. Some clients, great to see you, and some Calibre alum, great to see you on here with us today. So I always get the distinct honor, it seems, to present on one of the most interesting and exciting topics, accounting and auditing standard updates. I will try to make this as exciting as I can for us. Spoiler alert, we're still talking about leases, so that's going to be where we start off today. So let me just see if I can advance my slides here. All right, so we're still talking a little bit about leases. If you have a December 31st, 2022 year end, you will have already implemented this. If you have a year end after that, you are probably still working on implementing this if you are a GAAP basis financial statement preparer. We also have some accounting standard updates, but not many to talk about that are still kind of coming into play from 2020 that were issued in 2020 and a few in 2021. I will just let you know, I don't know if the FASB got a little bit tired, but there really have not been a lot more standards that have come out in 2022 and 2023. So only 2 so far in 2023. So not as much to kind of dive into, which is great because they were really busy for the last several years. So let's take another dive into leases just as a refresher and also for those that are still implementing this topic. So just as a refresher to remind you, prior to the accounting standard update 2016-02, so GAAP, how it used to be, you were accounting for leases basically through expenses, and you did not have to create an asset or a liability related to the lease. When it was put into place. That has now changed. So after Accounting Standard Update 2016-02, On the balance sheet, you're going to be recognizing a right of use asset and a lease liability for virtually all of the leases that you have that are over a 12-month term. The liability is going to be equal to the present value of the lease payments. So there is going to be a discount rate that has to be determined for the lease to be able to determine your total lease liability. And then the right of use asset is going to be a component of that lease liability and subject to adjustment for some initial direct cost and any other deferred lease incentives that were provided to you during the lease. After ASU 2016-02 on the income statement, the leases are going to be required to be classified as either an operating or a finance lease. Operating leases are going to result in more of a straight line expense, which is similar to kind of current operating leases. And then finance leases are going to result in a front-loaded expense pattern, similar to a current capital lease. There is a test for determining if you have a finance lease, and I'm going to cover that as we walk through our presentation a little bit more. So for lessors, nothing really has changed for those. It's very similar to what is in current GAAP. The leases are still classified as either operating, direct financing, or sales type. So that's going to include your leveraged lease accounting, but that has been eliminated. On the disclosure requirements, these have increased a little bit. What we had before is still basically going to be included. You're going to need to have a general description of the lease, the basis and terms and conditions on which any variable lease payments are going to need to be determined, the existence, terms, and conditions of any options to extend or terminate the lease, existence, terms, and conditions of lessee residual value guarantees, and then restrictions or covenants imposed by the lease. You are also going to need to include information about leases that have been signed but have not yet begun yet. So you'll just need to have disclosure information that is included in the footnotes for those types of leases. With respect to information about any significant judgments and assumptions that were made in the accounting for the leases, you're going to need to include some disclosures regarding whether you had contracts that contained leases, any allocation of the consideration in a contract between the actual lease and any non-lease components, so maintenance or things like that. And then how you determine the discount rate. And there's some options for that we're going to talk about as we walk through this as well. Continuing on with the disclosure requirements, you're going to need to include the main terms and conditions of any sale leaseback transactions. There's probably not very many things that are going to come into play for the labor union clients that we have related to that, but that is a disclosure requirement. And then there is a carve out in the ASU that says if you have a lease that's considered short term, so that's going to be any lease that only lasts 12 months or less, if you made the policy election essentially to not account for that under the new ASU, you'll need to disclose that you've made that policy election. So let's talk a little bit about what you should be thinking about when with respect to the guidance for implementation of this, for those of you that haven't done it yet. And just a refresher for those of us that have, there may be something that you didn't take into impact, and you might need to make a few changes going forward in the next year. But looking at whether you actually have a lease. And so that seems very straightforward, but I think one thing that I have learned kind of going through this initial phase of implementation with clients is I'm looking at other invoices that we've selected for testing, maybe with respect for repairs and maintenance or some other type expenses that we've looked at invoices for IT type things. There are some IT type contracts that actually do have a lease component in them if the organization is leasing computers or any kind of equipment like that. So looking at whether you actually have a lease. So a lease is defined as the right to control the use of an identified asset for a period of time in exchange for consideration. So what does control mean? So that means the right to the economic benefits of that asset and the right to direct use of the asset. This is going to involve some judgment in determining whether you have a right to direct use. In most instances, I don't think there's going to be much judgment involved, but there could be. If the supplier has substantive substitution rights, the customer does not have control. So you are therefore not going to have a lease. So if the supplier can come in at any time and kind of change out a computer or change out a piece of equipment, you really don't have a lease in that situation. So this ASU is not going to apply. The other thing in determining if you have a lease and the lease liability and the right of use asset is what is the actual term of the lease. And this used to be a little bit more straightforward. It was literally what was included in the lease agreement as the initial term of the lease. But the term now is defined as the non-cancelable period for which the lessee has the right to use the asset, plus any periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that actual option, the option to terminate the lease if the lessee is reasonably certain not to exercise that option, and then any renewals or extensions of the lease at the option of the lessor. The exception to this, of course, is going to be those leases that are 12 months or less, and so you don't have to apply this guidance at all. Third, determining the discount rate. That is supposed to be the rate that is implicit in the lease. And that is the rate that causes the present value of the new investment in the lease to equal the sum of the fair value of the asset minus related investment tax credits and the capitalized initial direct cost incurred by the lessor. Many of the leases that our clients are getting into, there isn't a implicit rate that's in the lease. So if you cannot determine one from the actual lease, you are supposed to use the incremental borrowing rate for the organization. So if you have a line of credit, that would be the rate that you use. Private companies, which nonprofit organizations would fall under, which the labor unions would fall under, they can elect to use the risk-free discount rate. And you can use that by class of assets. And when you're doing the initial implementation of this into a lease that's pre-existing 2022 or 2023, you're going to use if you're using that risk-free discount rate, you're going to use it as of the first day of the year of implementation with respect to how long the lease is going to continue to last. So there's a couple of different things in there that you need to pay attention to. One of the things I think that I'm seeing that clients are not taking into account is if they do have a line of credit, that is of course going to be that incremental borrowing rate. And as you know, the higher that interest rate is, the lower the calculation of the present value is going to be. So it is a little bit of a help. Because as we were implementing this as of January 1st of 2022, interest rates were fairly low. So it was causing that lease liability and the right of use asset to be calculated at a higher amount. Finally, on the guidance here, making a determination if there are any non-lease components. So just taking a look at those, an example of that could be an equipment lease contract also includes maintenance services. So that's not going to be accounted for in the same calculation of the lease liability and the right of use asset. You're going to carve that out. It's going to be expense just like it always was. So I just have a quick graphic here so you can kind of take a look at how do you come up with the lease liability and the initial right of use asset. We have designed a really nice spreadsheet that we've been providing to clients. If you don't have access to that yet, please reach out and we will get that over to you. It's very helpful. It actually links to the risk-free rates that are out there on the web. So it has a macro embedded in it, which is really helpful. And it creates the journal entries for you for each year and helps put together the numerical components of the disclosures that are required. So it's pretty helpful. But that initial lease liability is going to be the present value of the lease payments due over the term of the lease. If you're implementing during an existing lease, it's going to be the remaining term of the lease. You take that amount and then you're going to be adding to it any initial direct cost or lease payments that were made at or before lease commencement, and then subtracting from it any lease incentives that were received from the lessor. And that is going to be how you determine your initial right of use asset. And so just as a reminder, the reason why this accounting standard came out is so that financial statements of organizations that have purchased a building or purchased equipment can be more comparable to those organizations who've decided to lease space or lease equipment. So it's literally creating an asset and a liability that is going to be kind of consistent with those organizations. So a stakeholder kind of looking at your financial statements is going to be able to more easily compare the two organizations. We have our first polling question. So just asking, how difficult was it to implement the new lease standard? So if you were trying to get CPE credit, please provide an answer to this. So I'm going to continue on into the discussion about the classification of the initial lease. So determining whether you have an operating lease or a finance lease. What you're going to notice, if you remember prior GAAP for determining whether you had a capital lease, this is going to look very similar. It was a 4-prong test back in the day when you were looking at whether you had a capital lease. Essentially the same components here, they've just added one. So just as a refresher, you will have a finance lease if any of the following are met at commencement of the lease. So the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. The lease grants the lessee the option to purchase the underlying asset that the lessee is reasonably certain to exercise, or the lease term is for the major part of the remaining economic life of the underlying asset. But remember, back when we were looking at capital leases, that would have been a percentage that was included in GAAP, and I believe it was 75%. They have taken away the percentage and they're just using the terminology major part at this point. The fourth one here is the present value of the sum of the lease payments and any residual value equals or exceeds substantially all of the fair value of the underlying asset. Under old GAAP, when you were looking at whether it was a capital lease, that was quantified. It was 90%. Now they're just saying substantially all. So there's some judgment there. And then finally, and this one is new, the underlying asset is of such a specialized nature and would have no alternative use at the end of the lease term. So if any of those things are met, you're going to be calculating this as a finance lease as opposed to an operating lease. But in both cases now, under current GAAP, after implementation of this ASU, you are under both, you're going to have a right of use asset and a lease liability. So a couple of things to think about during the transition and some practical expedients to help ease the burden of adoption. You do not need to reassess whether expired or existing contracts are or contain leases. Just need to do that going forward. You do not need to reassess lease classification for any expired or existing leases, and you do not need to reassess any initial direct cost for existing leases. However, you may need to use hindsight in determining your lease term because that definition has kind of changed because it now includes whether you're going to have whether the organization is going to decide to take up any options to renew or extend. Okay, so that takes us through leases. Yay. I did not spend as much time on that as before because I feel like we've covered it and I think you probably have a good handle on it at this point. And I feel like I've been talking about leases my entire career. So we're going to move on to 2020. There were many new accounting standards that came out in 2020. The only one that we're going to really be talking to that could potentially have some impact on our labor union clients is going to be ASU 2020-07, not-for-profit entities. This has to do with the presentation and disclosures by not-for-profit entities that have received contributed non-financial assets. This was already applicable, so this again is just a reminder, a refresher, and to make sure that you've adopted this if you needed to. So we'll just kind of walk through this a little bit here. But the objective of this accounting standard update was to increase transparency about contributed non-financial assets through enhancements to presentation and disclosure. Not-for-profit organizations are going to be required to provide additional information on the contributions of non-financial assets that they receive. It does not really change how the value is calculated. We're really just talking about presentation and disclosure. So non-financial contributions of non-financial assets are also known as gifts in kind. Contributed non-financial assets can include fixed assets such as land, buildings, and equipment, the use of fixed assets or utilities, materials and supplies such as food, clothing, or pharmaceuticals, intangible assets, and those are all things that are recognized as non-financial assets. It also includes contributed services. So again, this is really just going to impact the presentation in the financial statements, and then again, the disclosures. So you're going to need to present these items as a separate component or line in your statement of activities. It can also be a separate column. I would only choose that option, and I'll show you the two examples of how it's presented. I would only choose that separate column if it's a main component of your activities. I think it's too much of a breakout if it's not very material to your financial statements. And then disclosure wise, you're going to have to disaggregate by the amount of category that depicts the type of contributed non-financial assets. So the new accounting standard update requires a not-for-profit entity to present these non-financial assets in the separate line. So we're going to take a look at that in an example. For each category of contributed non-financial assets recognized, there's going to be a significant amount of new disclosure related to that. You're going to have a qualitative information about whether the contributed non-financial assets were either monetized or utilized during the reporting period. If they were utilized, a description of the programs or other activities in which those assets were used is going to be required to be disclosed. The organization's policy, if they have one, about monetizing rather than utilizing contributed non-financial assets, that will need to be disclosed. You're going to need to include a description of any donor-imposed restrictions that are associated with the contributed non-financial assets, the valuation techniques and inputs that were used to arrive at a fair value measure in accordance with the requirements of FASB Topic 820, fair value measurement at initial recognition, and then the principal market or most advantageous market that was used to arrive at a fair value measure, if it is a market in which the recipient not-for-profit is prohibited by a donor-imposed restriction from selling or using the contributed non-financial assets. Couple other things to take into context here. This does differ right now from current GAAP. So subtopic 958-605 does specify the requirements for recognition and initial measurement of contributions and disclosure requirements for contributed services. It does not include specific presentation requirements for contributed non-financial assets or specific disclosure requirements for contributed non-financial assets other than those contributed services. So this is increased guidance from the FASB on this. This is supposed to help improve financial reporting, which is what most of their guidance is all about. So that is what this is supposed to do. So the next couple of slides are going to include some illustrations of disclosures, and these I actually pulled out right from the ASU that you can find online. But you can see this is the separate line illustration of under revenues, gains, and other support. You're breaking out the in-kind or the non-financial contributions from other cash and other financial assets on the financial statements. In this particular instance, the in-kind was actually the most material revenue that was coming into the organization. So they've shown it as a separate line. But the other option, of course, as I mentioned, was to show it as a separate column. So in this instance, you can see because it was so material to the financial statements, I don't think this is too busy for this particular organization. However, if it's not really material to your overall operations, I would just elect to do the separate line. It makes it a little bit less cumbersome to kind of take in the information that's being provided. So that's the face of the financial statements. With respect to the disclosures in the financial statements, there's a couple of different options here. This is the first one. You're going to have to include some kind of table unless you only have one type of these types of non-financial contributed assets. If you have more than one, you really are going to need to use a table. In this illustration, we've got a table that breaks them out by type. And then following that in the illustrative disclosures, there's several paragraphs, a paragraph for each type, that provides all of the additional information that needs to be included for each of the types. I personally think this is a little verbose, and it's hard for the reader to kind of take this information in at a glance, which is what, you know, most readers are doing, to kind of take in all the information that is in the financial statements. So there is this other option that is provided, which basically puts it all in a table. I think this, to me, as a reader of the financial statements, is a little easier to kind of take it all in. But at a minimum, this is what's going to need to be disclosed. You're going to still need to disaggregate these by type to indicate how much revenue was recognized, whether there was any utilization in programs or activities, and which ones. So you can see this is broken out by general and administrative, if even those have to be recognized, or the actual mission program type activities, whether there were any donor restrictions associated with the gift, and the valuation techniques and inputs that were used. So if this doesn't apply to you, obviously you're not going to have much to do with this specific ASU, but if it does, just make sure that the disclosures that you have in your financial statements are up to date with respect to this. So that's all for 2020. For 2021, they were still fairly busy issuing accounting standard updates. I just want to dive into one specific, which has to do with intangibles related to goodwill and other type of intangibles. So that's topic 350. There was actually one other accounting standard update. It was actually the first one that came out in 2021 that relates to reference rate reform. This has to do with the fact that LIBOR is going away or has gone away. So this particular ASU 2021-01 applies to all organizations that have derivative instruments that use an interest rate for margining, discounting, or contract price alignment that is modified as a result of the reference rate reform. And the amendments in it also optionally apply to all entities that designate receive variable rate, pay variable rate, cross-currency interest rate swaps as hedging instruments and net investment hedges that are modified as a result of that same reference rate reform. So there's going to be another one that I talk about that also has to do with the reference rate reform. So I was just trying to link those all together for you. But let's dive into the one that has to do with goodwill. I doubt this is really going to apply to a lot of you, but it potentially could, because there are, it does specifically relate to private company alternatives, such as not-for-profit organizations. So the amendments in this update allow an entity within the scope of this guidance to elect not to monitor for goodwill impairment triggering events during the reporting period, which was the requirement before, and instead to evaluate the facts and circumstances as of the end of the reporting period. That could be your year end, or if you have interim reporting periods, it could be those interim reporting periods. So to look at those at the end of the reporting period to determine whether it is more likely than not that goodwill is impaired. Monitoring for triggering events during the period, the entire period, was a very time-consuming exercise. And it was thought that the effort to do that did not actually outweigh the value that it provided. So this accounting alternative should reduce the cost and complexity for financial statement preparers by aligning the triggering event evaluation date with the reporting date, whether that date, again, is an interim date or an annual reporting date. Additionally, the amendments may provide more relevant information for users because the triggering event evaluation will reflect the facts and circumstances present as of the end of the reporting period for which those users that receive the financial statements. So you're going to end up getting better information that's more up to date. The bottom line, eliminating this ongoing triggering event analysis instead allows organizations to evaluate the facts and circumstances as of the end of the reporting period to determine whether goodwill impairment has occurred. So you are supposed to amortize goodwill over 10 years or less, subsuming certain customer-related intangibles, all non-compete agreements into goodwill and amortize, and then test goodwill for impairment at the end of the reporting period instead of upon a triggering event. So this is different from what happened way back in GAAP, where goodwill was amortized. Now we're just looking at it for impairment. So you have that option to do the impairment test at the entity level now instead of at the reporting unit level. So if you don't have this, it's not going to be applicable to you, obviously. And that's all we're going to talk about on goodwill. Moving on to ASUs that came out in 2022, really only the one that relates to the reference rate, which is going to be fairly quick for us to move through, but I'll just let you know, there actually were only 6 ASUs that were issued in 2022. So the FASB was giving us a little bit of a break, and most of them really had no impact on the tax exempt community or our labor union clients. So this, the update 2020-04, the original reference rate reform, topic 848. That was the facilitation of the effects of reference rate reform on financial reporting, which provided optional guidance to ease the potential burden in accounting for or recognizing the effects of that reference rate reform on financial reporting. So the FASB included in that a sunset provision within topic 848 that was based on the expectation of when they thought the LIBOR would cease being published. So at the time of that update, 2020-04 was issued, the UK Financial Conduct Authority, the FCA, had established its intent that it would no longer be necessary to persuade or compel banks to submit to LIBOR after December 31st, 2021. As a result, the sunset provision was set for December 31st, 2022, 12 months after the expected cessation date of all the currencies and tenors of LIBOR. However, in March of 2021, the FCA announced that the intended cessation date of the overnight 1, 3, 6, and 12-month tenors of USD LIBOR would be actually June 30th of 2023. So that's in a couple of days, which is beyond the current sunset date of topic 848. So they needed to issue this to basically extend that out a little bit. So the update defers the sunset date of topic 848 from December 31st, 2022 for another 24 months, December 31st, 2024, after which entities will no longer be permitted to apply the relief in topic 848. So just wanted to give you an update on that. With respect to 2022, FASB is really slowing down. So we're halfway through the year at this point. They've only issued 2 ASUs in 2023. The 2 issues addressed in this first one that was issued, which again has to do with leases and talking about common control arrangements. They were just trying to clarify some things with respect to that, is going to apply for calendar year 2024, but of course, early adoption is permitted. There are 2 issues that are actually addressed in this accounting standard update relating to the common control arrangements. So issue 1 is a practical expedient, and it has to do with using written terms and conditions of common control leases. In determining if a lease exists under this practical expedient, an entity must determine whether written terms and conditions convey the practical, as opposed to the enforceable, right to control the use of an identified asset for a period of time in exchange for consideration. An entity is not required to determine whether the written terms and conditions are enforceable when applying the practical expedient, and an entity may apply it on an arrangement by arrangement basis. If there are no written terms, conditions, the entity cannot apply this practical expedient. So this is really just going to impact the disclosure. So we have our second poll here. My organization doesn't receive any contributed non-financial resources. So just mark true or false. The second issue that's included in this accounting standard update has to do with accounting for leasehold improvements with respect to common control arrangements. So you're going to need to amortize leasehold improvements over the useful life of the leasehold improvements to the common control group, as long as the lessee controls the use of the underlying asset through a lease. So it's only going to be for that component of the control group, and then account for any remaining leasehold improvements as a transfer between entities under common control through an adjustment to net assets, if and when the lessee no longer controls the use of the underlying asset. So if it's kind of moving around between this control group. And that's pretty much it as far as accounting standard updates go. I know we've been busy over the last 5 or 6 years implementing some pretty significant things. So it's nice to have a little bit of a break after we get through the leases. So the final thing I want to talk through is just a few new auditing standards. And at this point, you should have all been through an audit that applied the significantly impactful new auditing standards, which changed the form of the report, kind of the way that it's structured, added some additional language to the report that comes out at the conclusion of the audit, and some of the other deliverables that we provide you at the conclusion of a financial statement audit. So that's all gone through. Those were issued back in 2019 and were supposed to be applicable for calendar year 2020 audits. And then going forward, when COVID hit, they did issue another auditing standard that allowed firms to decide if they wanted to postpone those for a year, because they thought during COVID it would be very cumbersome to be implementing that new standard, which Calibre did decide to do for our clients. But those should have all been implemented at this point. And so your reports, hopefully we've been through those with you and explained kind of the differences. So the only ones I really wanted to cover here were some that came out in 2021. And just so you know, there haven't been any new auditing standards that have come out since 2021. So nothing in 2022 and nothing in 2023. So we're just going to cover the last two just to kind of give you an idea of kind of some of the things that are impacting the work that we do, and that you might notice we're asking different questions or digging into things a little bit more deeply. You'll kind of have an idea of why. This first one, SAS 144, has to do with the use of specialists and use of pricing info from external sources. So the standard is responding to some feedback that sought more guidance on auditing the fair value of financial instruments. It is effective for audits of financial statements for periods ending on or after December 15th, 2023, although early implementation is permitted. The changes to the extant AUC section 501, 540, and 620, that's where we can see it in the actual standards. It provides guidance in AUC section 501 on applying SAS number 143 when management has used the work of a specialist in developing accounting estimates. And it also provides enhanced guidance about evaluating the work of management specialists. So the amendments are to the various applicable material paragraphs that provide guidance on when this comes into play. And these amendments are not intended nor expected to change existing practice. So a few other things we should talk about with respect to SAS 144. The changes in section 540 relate to requiring the auditors take into account the relevance and reliability of information to be used as audit evidence, and that includes its source, and contains an appendix addressing the use of external information sources. So just providing us additional information on what we are allowed to obtain with respect to outside information. Section 540 has also been amended to add a new appendix, the use of pricing information from third parties as audit evidence. And this was with respect to specific ask to add something related to that. It provides guidance on using such information as audit evidence for estimates related to the fair value of financial instruments. It also includes an appendix that's based on special topics from the PCAOB. So kind of aligning those two authoritative literature together. And the Auditing Standards Board believes that the requirements included in Appendix A of 2501 are consistent with the procedures that would be performed by auditors to comply with the principle-based requirements in AUC Section 540. So it really is trying to align those two documents, making sure that financial statements that are issued under PCAOB and those that are issued outside of PCAOB are a little bit more comparable. So SAS 145, just taking a look at that, this was understanding new auditing standards with respect to the work that we have to do with understanding the entity and its environment and assessing the risk of material misstatement, which is what we do to help us determine what procedures we're going to be performing during the audit. So why did this come up? So there were deficiencies in the auditor's risk assessment procedures. That was a common issue that was identified by practice monitoring programs in the US and worldwide. And so this SAS was issued to kind of tighten that up. So in 2020, US peer reviews the currently effective AUC Section 315, understanding the entity and its environment and assessing the risk of material misstatements was the leading source of matters for further consideration as a result of peer reviews that were completed. So those were issues that came up during peer review that potentially caused a CPA firm not to receive a passing grade on that. So this SAS was issued in October of 2021 to address that. It really just sharpens the focus on risk-based auditing, and it takes effect for audits of financial statements for periods ending on or after December 15th, 2023. I would say it's very likely that we will be posing more questions, maybe digging into things a little bit more than we used to, but really it's just clarifying some things. We were already supposed to be doing this. It was issued to help auditors determine which areas pose the greatest risk of material misstatement in an audit engagement so that we can spend more of our time performing procedures in those areas. The new standard is designed to enhance the requirements and guidance for identifying and assessing the risks of material misstatement, particularly the areas of understanding the entity's system of internal controls and assessing control risk. So with respect to that, SAS number 145 does not fundamentally change the key concepts underpinning audit risk. Rather, it clarifies and enhances certain aspects of the identification and assessment of the risk of material misstatement to drive better risk assessment and therefore enhance audit quality. The standard also includes extensive guidance regarding the use of information technology and consideration of general IT controls. It revises the definition of a significant risk. It includes a new requirement to separately assess inherent risk and control risk, which is part of the overall audit risk formula. It includes new guidance on maintaining professional skepticism. It includes a new standback requirement that is intended to drive an evaluation of the completeness of the identification of significant classes of transactions, account balances, and disclosures by the auditor. So not a lot of substantive changes, really just taking into account fine-tuning this and clarifying it and providing us a little bit more guidance to make sure we are continually enhancing the quality of the audit work that we are performing. So that is really all I have to share. So we have one more poll under my session. I'm looking forward to closing the book on accounting standard updates regarding leases. Hopefully you say true, because that's how I feel. It was great to be here with you today. I'm going to turn it back over to Jim to introduce our next speaker. Thank you so much.
Okay, great. Thank you very much, Mary Margaret. Now we're pleased to introduce our next presenter, Art Budick. Art is an audit partner at Calibre CPA Group, and he'll be discussing best practices for managing fraud risk today. Art holds certifications as a CPA and a certified fraud examiner, and he's an integral member of the forensic and risk advisory team here at Calibre. With his considerable experience in auditing, Art has developed extensive expertise in labor unions, employee benefit plans, and other not-for-profit organizations. His knowledge includes trade and professional associations, charitable organizations, and advocacy groups. So welcome, Art.
Thank you, Jim. And welcome everybody to our 11th annual conference. It's amazing to think that now we've been doing this for 11 years. It's now slotted in right between Memorial Day and 4th of July as one of the markers for my summer. So with that, I'm excited to be back with everybody again to be talking about fraud. We're going to be going through first some statistics, some industry statistics, and then we're going to be taking a look at, as it says in the title screen, best practices for managing fraud. But really, we're going to be taking a look at a comprehensive approach to manage fraud risk within an organization. There we go. Sorry, my screen was taking a moment to respond. So with that, we're going to start off with the definition of fraud. The definition I have chosen: any intentional act or omission designed to deceive others, resulting in the victim suffering a loss and/or the perpetrator achieving some gain. In this case, the victim would be any of our organizations, our labor unions here, that we are representing, that we either represent or that we audit. Now, one important thing to note, first of all, there's many definitions of fraud. We're all susceptible to fraud, whether it be personal or within our organizations. So it can take many different forms. Please keep that in mind. Now, as we move forward and we start looking at statistics, probably the next 10 slides or so are going to be looking at statistics. We're going to be looking at a report that was done by the Association of Certified Fraud Examiners. It's issued every 2 years. It's conducted globally, and it takes a look at the types, causes, signs, and costs of fraud across a variety of industries. And again, it is a global survey. The latest survey was issued in 2022. It studied over 2,000 cases from over 130 countries in 23 distinct industry categories and total losses of more than $3.6 billion. So there's a couple important disclaimers here when it comes to this survey. First of all, for those of you that attended this conference last year, you'll see that these slides are repetitive. Again, this is only issued every 2 years. Now, I do think that it's fair to continue to use these first couple slides looking at statistics, because I did look back over the last decade or so, and generally, the trends have remained pretty consistent with the information that we're looking at, certainly within a very narrow bandwidth when it comes to the types of fraud, dollar impact, and across different industries. So the information is still current, and I think when we see the next survey issued in 2023 that looks back over these previous 2 years, we're going to see similarities again. Another important thing to disclaim here is that this is a survey. It's based on information that's provided by certified fraud examiners in the industry and their experience. So when we say that the total losses in this survey were $3.6 billion, it's very likely, probable, that this is only a small fraction of the fraud costs that one would see across industries, certainly globally. So please keep that in mind as we are looking at this information. So we're going to be looking, we have three fraud schemes up here: misappropriation of assets, which is just generally the theft or misuse of assets; fraudulent financial reporting, which is misrepresentation in financial reports; and then corruption. Generally, when you have corruption, it is also an earmark of one of these other two types of fraud schemes. It's kind of difficult to have corruption exist in of itself or on its own. Now, in the labor community, and certainly in most of our experience, most of what we see has to do with the misappropriation of assets, and that is going to be some of the focus of what we look at today. That being said, there are risks of fraudulent financial reporting within union financial statements. The most obvious one to me, when I'm thinking about the organizations that we audit and that you all represent, would be for those of you that have significant notes on perhaps property loans, buildings, those kinds of loans. Banks often have certain loan covenants, and there could be certain conditions that might be difficult to meet in a given year, or there could be stiff penalties for not meeting them. There could also be instances where there are loans outstanding to related parties, locals, things of that nature, and there could be a reluctance to recognize allowances or to write those off. So those are just two instances that I can think of immediately when it comes to fraudulent financial reporting that could apply to the labor community. I'm sure there's a host of others. But again, we're going to be looking at primarily the misappropriation of assets. Conveniently enough, when we're looking at the types of fraud schemes, our focus aligns with the percent of cases that were observed in the global survey that was conducted. In the survey that was conducted, we saw that 86% of the cases involved the misappropriation of assets, as opposed to only 14% being fraudulent financial reporting. Now, the median loss, on the other hand, was much greater when it came to fraudulent financial reporting, as opposed to the misappropriation of assets. As I noted earlier, looking back over the last 8 to 10 years of information, this has really remained consistent year over year. I think the lowest as a percentage that I looked at was maybe 84%. The highest was 87%. So again, we're right within that bandwidth, and I would expect when they release the next survey in 2024 that we're going to see similar information then. As a percent of cases by organization, we see, again, pretty narrow bandwidth between 20 and 30%, depending on the organization size. And I suspect that the organizations that we have here probably fall within these first two categories, either the less than 100 employees or certainly the 100 to 1,000 employees. So, the cases that we looked at in the survey are generally represented within this 20, probably about 50% of the cases. Now, the median loss by organization size, however, as we can see, is disproportionately emphasized here in the less than 100 employee category. So why this is significant, while the median loss might be $150,000, to your smaller organizations, and I think generally we can assume that your smaller organizations are going to have less employees, the impact of that loss is going to be outsized when you think about it compared to a much larger global organization, those with 10,000 employees or more. And throughout this, I'm going to reference some of the experiences that I've had while conducting fraud examinations with Calibre or for Calibre. One organization comes to mind immediately. Over the last couple of years, it was an investigation that we performed, a smaller organization, and we found losses there of about $400,000. So certainly in excess of the median losses that we're seeing here reported. What really outsized the impact there was when talking with the board and disclosing our findings to the board, it was noted that significant effort had been put in over the previous decade to build up the assets of that organization to about $500,000. The period of the losses was about a year and a half. So the board members were greatly impacted, greatly affected to see that their work, the efforts that have been made to carefully steward the organization and build up those assets had been lost in that period. So again, what we're seeing here is that the losses are outsized in these smaller organizations. And then again, the impact is going to be outsized as well. Moving on, not a lot to dwell on this slide here. I think it stands to reason that the longer a fraud goes on, the larger the loss would be and would be expected to be. So kind of in line there with expectations. And then the duration by type, generally what was found was most frauds were happening over about a 1.5 year period, 18 months or so. So we can see here, and certainly my experience, the most frequent types of frauds that were found in the labor community: expense reimbursement schemes, check and payment tampering schemes, and payroll schemes. As I just mentioned, the fraud that I referred to a moment ago, that happened over about an 18-month period. So really falls in line here with the experience of the survey. Now, velocity, that references the expected loss per month on average, or median loss per month for these different types of fraud schemes. And we can see here expense reimbursement schemes, which again tend to be the most prevalent in the labor community, were reported at about just over $2,000 a month. Now, while that might be true in the survey, I will say anecdotally that my experience has been that the expense reimbursement schemes, while maybe they start off on the smaller side, they tend to gain velocity as they go month over month. And if we look back and we saw, the median length of an expense reimbursement scheme, while it might have been 18 months, we can do the math. You would be led to believe that the expected loss would be about $36,000. My experience has been that the expense reimbursement schemes have actually been far greater than that in their cost, oftentimes well in excess of $100,000. Fraud and how it's detected. There are numerous ways, whether it be preventative measures or detective measures, but by far tips from both within the organization and outside the organization are the most prevalent and the most successful when it comes to detecting fraud. Here we see in excess of 40%. And again, looking back over the previous 8 to 10 years, this has remained consistent with well over 40% of the frauds being reported in the survey having come from tips. And again, I said, both within and outside the organization reporting fraud, by and large, as we can see here from the survey results, most frauds are coming from individuals within the organization. And that is to be expected, especially within the labor community, given the nature of the frauds that are being uncovered. Now, we said tips are being the most prevalent or most successful way of detecting fraud. And there were 3 main types that were noted in the survey: telephone hotlines, emails, and web-based. All successful, and quite honestly, rather than focusing on one as being better than another, I would urge all organizations to have as many types of fraud reporting mechanisms as possible. First of all, as we saw, they're the most successful way of having fraud reported. But in addition, you don't want an individual to feel that they don't have a comfortable or private way of reporting fraud. And comfortable and private are going to mean different things to different individuals, depending on the nature of the fraud, the nature of the organization, the comfortable or how comfortable an individual is with technology. Although telephone hotlines might seem antiquated, for some individuals that still may seem to be the most comfortable way to report a fraud, while others might prefer email or web-based or some other mechanism. So again, while we can see here that fraud is reported through different types of mechanisms, I would again urge just to have as many as possible so that there's no never any instances where an individual feels they don't have a safe, confidential, and non-retaliatory way of coming forward to report fraud. So we have our first question here. Does your organization have a fraud training program for employees? Later on in the presentation, I'm going to be talking about fraud training. It is certainly one of the most valuable things we can do within the organization to prevent fraud, and certainly something that if your organization is not doing, I will urge you now, and I will urge you later on in the presentation to consider doing. So please answer that question. But moving on, so I've been talking about the quantifiable costs of fraud, the median costs of expense or fraudulent financial reporting or asset misappropriation schemes. But there are also a lot of non-quantifiable costs, and depending on your organization, those may be even more costly. What we have up here, or what I have up here, loss of trust in management, breakdown of organizational cohesion, increased scrutiny from the outside, employee management turnover, loss of trust of members, and reputational damage. These are just a couple of the non-quantifiable costs that your organization can be hit with if there is a fraud and the fraud becomes public. Within the labor community, we are placed in a position of having the trust of our members to do not only what's best for the organization, but what also is best for the individual, and using their dues money in that vein. So one of the most costly non-quantifiable costs that can happen to a fraud is having that loss of trust of members, where they feel as though their dues are no longer going in the most towards the best use of the organization. Also, the reputational damage that can be felt by the organization if fraud is made public is also rather great. And John Lund is going to be talking later on today about the Department of Labor, but I think everybody here would agree that we would like to avoid having increased scrutiny from outside, particularly the Department of Labor. And if fraud is uncovered, we are required to report that on the Form LM2. And more likely than not, that would trigger at least some questions from the outside. So there certainly are some significant non-quantifiable costs to go along with those, the dollar costs of fraud within the organization. Here we go. So just a moment for me to editorialize here now that we've gone through and talked about the findings from the survey that was issued in 2022 and the 2 years preceding it. Obviously, we're all aware as we're emerging from the effects of COVID that the pandemic greatly changed the way that we do business, whether it be where business is done. There's certainly a tremendous shift to remote work, whether it be temporary or for some organizations more permanent. There's also been an unprecedented change in the speed, or an unprecedented speed of change to control structure to go along with that remote workforce. Those changes all happened in a very short amount of time. And we're probably now starting to see some of the effects of those changes. As we saw, a lot of frauds took over a year, 18 months, 2 years to be uncovered. So if those changes were taking place during COVID, it's more than likely that we're starting to see now some of these control breakdowns, issues, and unfortunately, probably some frauds that have been taking place during this pandemic stage. So we're going to be taking a look now as we move forward about what we can do from a fraud risk standpoint in managing that fraud risk. But I think we should keep in mind the impacts of the pandemic and how it changed our workforce and how it changed the way that we do work. So what can we do? It's not practical to eliminate all fraud risk. Our goal should be to manage fraud risk. And what does that really mean? Well, there's a couple of ways that we can manage fraud risk. The first way is to transition or transfer that risk. Hopefully, all the organizations here that are represented have some sort of, having the appropriate insurance to cover the organization, whether it be cyber or otherwise. That helps to defer some of those risks. But then the other thing, or another step that is certainly necessary, and something that we're going to be talking about now as we move through this presentation, is a fraud management program and taking a look at it. So as we're working through this program, we're going to be faced with two decisions then: taking steps to mitigate the fraud, or taking steps to accept the fraud. Now, it might seem, or the fraud risk. Now, it seems counterintuitive to say accept it, but as we're working through these programs, we have to determine what's the economic risk, what's the risk to the organization, and whether or not it makes sense to put in place procedures. So the diagram here demonstrates what an effective fraud risk management program should look like. And we're going to take a look at each one of these steps. First, establishing a fraud risk management policy as part of organizational governance, performing a comprehensive fraud risk assessment, selecting, developing, and deploying preventative and detective fraud control activities, establishing a fraud reporting process and a coordinated approach to investigation and corrective action, and then monitoring the fraud risk management process, report results, and improve the process. Like I said, we're going to go through each one of these, but the main thing I want to point out on this slide is that you should note that it is not a closed loop. This process is not a standalone process that we can complete once and then, kind of cross it off the list and put it away. As we all know, fraud schemes are continually evolving, and our responses to those schemes are also going to have to evolve over time. If we were to take a poll of the room, I think one of the most frequent schemes that we're seeing right now have to do with email scamming schemes, attempts to get organizations to write checks to fictitious organizations, or maybe send ACHs to fictitious organizations. Those are certainly some of the most prevalent schemes that I'm hearing about now and they get contacted about now. Those are the ones that are, currently, the most prevalent, but 6 months from now, there could be other schemes that are emerging, whether it be as technology changes or the way we do business changes. And that's why it's important to make sure that our fraud risk management program also evolves. So the fraud risk management program that you complete now will then serve as a basis when you revisit this, hopefully in 6 months or 12 months from now. But again, it needs to be a regular part of your management process of your organization. So the first step, establishing a fraud risk management program. It needs to be established, and then, as I've underlined, communicated to the organization. And really, this needs to happen at the very top of the organization from the board of directors. The board or similar, management, group tasked with oversight of the organization needs to clearly state its expectations of governance and management, as well as for its employees. By stating this expectation, it demonstrates a commitment to the integrity and ethical values of the organization. And again, it needs to regularly be reviewed and updated, and it needs to be communicated with a focus on deterrence, prevention, and detection. As we move through and we're talking about the risk management program, a lot of the steps that can be done are hopefully preventative and done to deter somebody from trying to commit a fraud. The ultimate goal when we're managing fraud risk is going to be trying to prevent and deter fraud. As we saw when we were looking at the time that it takes to detect a fraud, by then, the organizational, non-financial and financial impacts will have been felt. But by showing a strong tone at the top, by being out in front with your employees and showing the ethical the ethical values of the organization, it can really go a long way to deter and prevent fraud from taking place. So again, demonstration of ethical behavior by governance. And again, we want to be, when we're talking about a fraud risk management program, we really want the foundation for deterring and preventing to be based on business ethics. There's other controls that are going to be in place that are going to be based on compliance, and that's to prevent a wrong legal or regulatory decision. A lot of what it comes to with the fraud side is going to be making sure that we're making strong ethical decisions as well. So the second step is going to be to perform that fraud risk assessment. After governance has kind of put forth their, their idea and their values on fraud risk to the organization, it then becomes the duties of management to make sure that that assessment is being carried forth. And as I said a moment ago, hopefully this isn't your initial assessment, but if it is, this initial assessment will then form the basis as we move forward and repeat this process at least annually, hopefully more frequently. So first and foremost, what we need to do is we need to make sure that we get all the key players in the room. That's going to be different for each organization. I would expect that it's going to be your accounting and finance folks, HR as well, probably IT, perhaps your membership department, depending on the size of your organization, maybe your political department. Again, it's going to be unique to your organization and your organization's unique risks. I've used that word unique several times, and it's here in the third bullet as well. It's a unique process to each organization, addressing its individual needs, its specific complexities, and your goals. The initial assessment will form the basis for your subsequent assessments. So again, I just want to reiterate that this is a unique process, and it's really a brainstorming process. As we're going through the process, you're going to be looking at your internal controls or considering your internal controls and how they respond to your different perceived weaknesses. There's an important thing to think about when we're looking at internal control. Most internal controls are designed with the idea of preventing an error. When it comes to fraud controls, it's not so much an error, but intent that we have to consider as well. A well-designed series of internal control might not properly address somebody who's intentionally trying to circumvent those controls. So a good example of that is an organization that I worked with a couple of years ago, where they had a very large ACH, fraudulent ACH go out, and they wanted a look at their internal controls from an outside party, and also to make sure that there hadn't been any other frauds that were perpetrated. And when we looked at their internal controls, they were well designed if you thought about, checking all the boxes. There was, good separation of duties. There was a good process of inputting the data, of review of the data, of final approval of the payments. Where the controls broke down was when it came to the intent. While, all the correct sign-offs were there wasn't a control in place to prevent somebody, once it had been approved, to go in and alter the payee for an ACH. And that's exactly what happened in this process. So they were able to show that the ACH run in particular had been properly processed and approved. But again, it was somebody who intended to circumvent the control. There wasn't anything to prevent that. So again, when we're going through this process, we need to be making sure that there are controls in place, not only to prevent an error, but also a control in place to prevent somebody with a fraudulent intent. And as we're going through those controls, we want to make sure that we're thinking about, some of the things that are highlighted here. What controls are most critical to the process? Are there risks, pressures, and incentives specific to members of management, governance. I should also have here just the people that are responsible for any given process. As I mentioned earlier, when we think about the changing workforce, the changing work environment, and the changing roles that technology plays, that really needs to be first and foremost in this, fraud risk assessment. How has technology impacted a certain process? And that might change, every couple months. Again, as we think about the pandemic, there was probably a great shift for many organizations from, your standard, more paper-based checks for payment to those that are now done in electronic process. And there has to be special attention given to not only what that process is now, but how that process and those approvals were changed, and if there are any weaknesses there. And then again, as I mentioned, we always have to be vigilant to new fraud schemes that might have arisen since our last assessment. So it really does have to be a continuously evolving process. So the selection, development, and implementation of controls, again, preventative are the most effective. Among the other benefits, a properly designed and communicated fraud risk management program will increase the perception of detection and reduce the perceived opportunity of fraud. This really can't be highlighted enough. We really want to be committed to having an environment where there's a perception that fraud's going to be detected, that there are not weaknesses in internal control, and that it will be detected, immediately. And in that way, it really does reduce the opportunity that somebody's going to try and perpetrate a fraud. As we, move forward here and look at a couple more statistics, return to those charts for a moment. But it shouldn't be a surprise to anybody to see that the loss for organizations that had controls in place versus the loss for organizations that did not, it's much greater for those organizations that had controls in place. First of all, they were able to detect it earlier, but also it reduces the opportunity or the perceived opportunity for individuals to try and perpetrate a fraud. And also, as we look at anti-fraud controls and their duration, again, no surprise that the length of frauds for those organizations that had controls in place are less. Now, right down the middle, we see fraud training as one of the best ways, or one of the best anti-fraud controls that we can have. So certainly what is advised would be some sort of periodic mandatory training for all employees, that it's an effective tool available to reduce fraud, also to increase that perception that fraud would be detected. The training should be increased and more comprehensive for individuals in the financial positions and those with financial or with fiduciary responsibilities. So there are certain things that should be communicated to all individuals within the organization. There should be a code of conduct that's reviewed and available. It should, again, really be communicated frequently. And it really does show management's commitment to having an organization of high ethical value. There should also be a consistent review of an organization's reporting methods. Remember, again, there was that slide where we talked about hotlines, web and email reporting methodologies. Those should be reviewed frequently. They should be made available. They should be posted. Break rooms, kitchens, all types of places where individuals have those opportunities to see if they have a concern, how they can report it to somebody in a non-retaliatory way. And then, the third thing I have bulleted here is technology-related training. Really can't stress this enough. I think everybody here has probably been subject to some sort of spam email or fictitious attempt to get you or somebody within your organization to initiate a payment or send money to somebody who's send somebody money in a fraudulent manner. I know within Calibre we have regular, consistent an anonymous technology related training to this, so that all of our employees are vigilant to make sure that we're safeguarding our own client information, as well as our own company information. But then there are also other technology technology related steps that can be taken to shield your organization from disclosing information that you don't want out in the public realm. So, sometimes those are, blockers that can be placed on your emails to restrict certain information from being sent. Certainly making sure that you have secure ways to transfer data within your organization and without. All these steps are things that either, I urge your organization to continue to do, or if you don't have them in place, please let, myself know or anybody else from Calibre. Be more than happy to discuss them with you and some of the things that we do or that we see within the industry to try and make your organization as safe in that regard as possible. Now, when it comes to training, and certainly, training specific to certain individuals, I think it's important to take a look at, what are some signs of fraud? And, we always take a look at the fraud triangle. So, pressures, opportunities, and rationalization. Pressure that an individual might face to commit a fraud, the opportunity that an individual sees to commit a fraud, and then the rationalization, how a person goes about rationalizing the fraud they've committed. Now, the first two are things that can be observed if you're looking. Certain pressures that an individual might face, and then again, opportunities that might be uncovered when you're doing your fraud risk assessment. And as I've been stating throughout this presentation, the one thing that we really want to do that we can control is reducing those opportunities to commit a fraud. Obviously, we don't have any control over the pressures individuals feel. We can't really see the rationalizations that people make for committing a fraud, but we can control those opportunities and those perceived opportunities to commit a fraud. Now, the fraud triangle is something that has at least remained stagnant or static, I should say, in all the trainings that I've attended and all the trainings I've given for a number of years. This year, a bit of a curveball was thrown when some presenters have now started referring to a fraud pentagon. And I haven't changed this presentation to show those other sides, but the other sides that are being introduced now when you're doing your fraud risk assessment are competence. So when you're looking at individuals looking to see what their abilities are to commit a fraud. I know one fraud that was uncovered at one of our clients, the individual, while they had access to certain data, were not able to accurately shield their fraud. So it was caught within a matter of weeks because they were incompetent in the way they were committing the fraud. So that's certainly one thing that you want to take a look at, the competence of the individuals and what they could possibly do to hide their fraud. And then the other one that kind of goes along with rationalization is, arrogance or a sense of entitlement or greed, or just the general attitudes towards an organization. If you start to, see somebody who's presenting towards the organization in that manner, maybe that's something to keep an eye on as well. It's important to note, as we flip over here and we look at red flags, these are red flags that were seen in frauds that were perpetrated in the survey that was done by the association. Excuse me, but certainly in no way, a red flag does not mean that an employee is necessarily committing fraud. I know sometimes when I leave CPs and seminars, it sort of, makes me raise my antenna again, maybe higher than it naturally would be, really increases that sense of professional skepticism, makes me start looking at, red flags that might be out there. But again, just because there is a red flag, whether it be somebody who doesn't take vacation very frequently, somebody who's having, family problems, or maybe somebody who's living what you perceive as beyond their financial means. Again, these might be things to raise that level of skepticism, but not necessarily indicative to say, oh yes, this person's committing fraud. So they're just kind of, things that we need to take a look at in totality when we're looking and doing this fraud risk assessment. One other red flag, and here's my second polling question. I knew it had to be coming anytime now. Has your organization performed a fraud risk assessment in the last, and I said 1 year, 1 to 2 years, or more than 2 years ago? I didn't put down not at all. Hopefully that's not a selection anybody would be looking for. But again, if it hasn't been done, it's certainly within the last 1 to 2 years, I can't urge you enough to take this on. Moving back over to the slides though, age and median loss. One of the reasons I think that we see this, this trend line of it increasing with age and the median loss, certainly it could be because, again, you have somebody who has a feeling of entitlement after being at an organization or having a long career and feeling like maybe they're entitled to certain, benefits from their tenure. But then also just generally, we're going to tend to see people at an older age having more access and being in more of a position of management. So I don't really think it should be a surprise that we see age being a trend line with an increased median loss. I apologize. For some reason, it seems to take a moment for my slides to advance when there's a polling question up. Well, I'm going to keep on moving and eventually my slides are going to catch up with me. The fourth box in the fraud risk management program was establishing a reporting process. So again, we want to ensure that the organization has and develops a process for prompt reporting of any findings, whether it be internally or externally from outside sources, and any frauds that they find. And then moving on, what if your organization finds fraud? First of all, we want to restrict the access of the individual or individuals and make sure that the fraud doesn't continue. We want to determine the magnitude. You're certainly going to want to know that from not only internally, just to know what the impact is of your organization, certainly from an insurance standpoint. You're going to want to report it to your auditor and your legal counsel, making sure that any of the filings, such as the LM2, have the correct reporting in them, as well as the 990. You also want your legal counsel to be looped in, certainly, to make sure that proper disclosure can be made to governance as necessary. And then you want to take a corrective action as well, of course. And then finally, when we're doing this fraud risk management process, we want to continually be monitoring it. So as I said, it's not a closed loop. This is a process that will continue. It's going to have to be part of governance now, part of something that you do, as I said, no less than or no more than annually, or no less than annually. But again, it has to be tailored to your organization and your organizational needs to make sure that you are able to meet and respond to the different fraud risks as they come at us, because it's certainly not going to be something that is going to go away or slow down, unfortunately. So with that, I hope that you've gotten some good information to take back. Again, if you haven't been going through this fraud risk process, hopefully it's something that you will be soon undertaking. Our contact information, I'm sure everybody here knows how to get in contact with either myself or another representative at Calibre. And if it's something that you would like assistance with, perhaps some guidance, or perhaps to have a longer conversation, myself or any of the other partners at Calibre would certainly be happy to help you with that process in any way that we can. So with that, I'll turn it back over to Jim and conclude my presentation. Thank you.
Okay, great. Thank you very much, Art. We're going to go ahead and take a 10-minute break now before we move on to our featured guest speaker, John Lund. It is about 1:32 right now. Why don't we start up again at 1:42? We'll be right back. Thank you all. Welcome back. Before we go on, I want to encourage everyone to go ahead and ask any questions that you may have using the Q&A feature on your screen, and we'll address those towards the end of the presentation. So now let's please welcome our featured guest speaker, Professor John Lund, former director of the Office of Labor Management Standards with the Department of Labor. He'll be reviewing best practices in labor union financial compliance. John holds the distinguished position of a professor emeritus of the School of Workers at the University of Wisconsin, where he dedicated 24 years to teaching. During his tenure there, he also held joint appointments in the Industrial Relations Research Institute and the Department of Industrial and Systems Engineering. Throughout his career, John has made significant contributions in teaching, research, publications, and outreach work. His areas of expertise span a wide range of subjects, but they include union finances, production standards, collective bargaining, ergonomics, job evaluation, and union administration. President Obama appointed John as the director of the Office of Labor Management Standards at the U.S. Department of Labor in 2009, where he served 4 years. He also served as Secretary of Labor Tom Perez's regional representative for the Pacific Northwest and Great Plains states until 2016. Since then, John, who lives in the Seattle area, has headed Pacific Northwest Labor Research LLC, a consultancy working solely with labor organizations. We're very happy to have him with us today. Thank you very much, John.
Thank you, Jim, for the kind words of introduction. Am I coming through all right, voice-wise?
Yep, I think we can hear you perfectly.
Oh, that's great. Very good. Thank you, Calibre, and thank you, everybody, for your attention today. I'm going to cover a couple of subjects with you. The first one is preparing for a CAP audit. CAP is, for those of you not familiar with the term, acronym, Compliance Assistance Program Audit. These have been around since at least 2000. They're directed at local unions and other affiliates. They're not specifically directed at international or national unions. There's a separate program for that called ICAP, which has been somewhat dormant for quite some time now. So let me just kind of walk you through the steps. You're in the national office, you may get a sort of a panic call from an affiliate or an international vice president saying, oh my God, my affiliate is going to get capped. Well, the first question, how are we selected? Well, typically it's the district director, and OLMS is organized into districts nationwide. They have the ultimate discretion whether to pull the trigger or not. But they have, since my tenure at OLMS, used a red flag system, which is basically sort of internal factors that are a maximum likelihood of achieving what's called a fallout. And a fallout means that it's a criminal case being opened up. So in other words, it starts off as an audit, but there's enough evidence to warrant opening up a criminal case. And that, in the parlance of OLMS, that means there's a fallout. So in other words, you're picked because there's indication that there may be potential criminal wrongdoing. These are not random audits anymore. They used to be under my predecessor, Don Todd's tenure. And very, very few of them were finding anything. Because of the resource restrictions, we had to go to something more efficient. We were actually able to achieve a 20% fallout rate during my tenure. I think that's backed off a little bit, meaning that 1 in 5 CAP audits that are open result in the opening of a criminal case. You'll get a letter and there's a questionnaire to complete, and then you get a phone call to schedule it. I would say for preparing, look over any previous CAP closing letters involving your union or any other local unions in the area. Generally speaking, the past is a pretty good guide to the future. And if there have been similar audits of affiliates in the general area, they may also tell some information that would be very useful. Make sure you have 5 years worth of records. That's one of the first things OLMS is going to request. You'll need your general ledger. You'll need all of your account documentation. And nowadays, because of COVID, the audits are less likely to occur in person. OLMS may simply show up and take all the records. make sure you get a receipt for all the records that they take. They try to complete these typically within 10 business days, but sometimes they may take a little bit longer. There will be, following the questionnaire being turned in, an opening conference. Many unions still have their accountant present at that. Certainly the bookkeeper, the financial officer. Some unions want their attorney there. I personally don't think that's necessary, but some do. And they're going to kind of lay out the plan of attack. They'll take the records, and then when they're done, there'll be a closing conference. This is the important one to attend because you'll get kind of a preview of what's likely to come at the closing conference. Within really a matter of days or a week or two, the district director will send out a closing letter to the local union, and the same day it's sent to the local union, it's posted online. So you can actually go online to the OLMS webpage, click compliance audits, and you can find all of the compliance audit closing letters. Not quite like a management letter in accounting parlance, but it certainly will preview what was found. It's going to focus on reporting issues, where there are problems or mistakes in the LM 2, 3, or 4. If there are, then generally that requires the filing of an amended report. Record keeping issues are also pretty big. Do you keep original receipts? There's no de minimis there. For meal receipts, do you have the original receipts that show the itemized expenditure by individual? Is that all there? Mileage logs, inventories, things like that. And then policy matters. They're going to be asking you nowadays, do you have an expense policy? Do you have a travel policy? And if not, they'll certainly make recommendations for that. This is a sample closing letter. I've taken all of the identifiers out of it, but this is a fairly recent one. The local did not require officers to submit itemized receipts for meal expenses for at least $300. It doesn't mean they didn't require them at all. There weren't expenditure records for up to $300 worth of expenses. And again, that's necessary. Also, the written explanation. Remember, there's several points of identification that have to be on each meal expenditure, whether it's a credit card receipt or whatever. And that's going to include the name or names of individuals that partook in the meal, their title or position, and then the specific union business discussed at the meal or the business purpose. And you can't just write down their union business. That's not sufficient. The general rule is what must be written down would be sufficient for OLMS to determine that the expenditure had been put into the proper functional activity category. So union administration, representational activities, political action, and lobbying. And it says the policy that union officers are not entitled to charge meals on their union credit cards because they're already compensated $35 a day, but 2 officers charged a meal totaling $90 with no union business purpose. So, they will look at all the meal receipts, and any exceptions noted will be part of the closing letter. I want you to understand that these closing letters are very carefully scrutinized by management, by union busting consultants. We've seen many of them surface in organizing campaigns. So really stress upon your affiliates that, just 1 or 2 things being mentioned may seem like trivial, but it's a record that exists permanently on a publicly accessible website. And typically there's no real penalty when they note these things. It's basically, go forth and sin no more. It's kind of how it works. The bylaws very frequently, one of the first things that the OLMS will ask for is the Constitution and bylaws. They need that so they can see what financial policies and procedures are incorporated. If they're not the current bylaws, that automatically will trigger this finding that the current bylaws are not on file, so that will have to be submitted. And another very common finding is bonding, that the local is not adequately bonded. Many internationals carry a blanket bond and do their very level best to keep those up to date. The problem is that many unions simply don't reflect that up-to-date information, and they just put the same bonding amount from the previous year. So it's definitely of value, and I'll show you how to do this later, to check through to make sure that the bonding levels are updated. Just some other typical things: failure to retain original receipts, credit card records, vehicle records. They still have to have the vehicle logs. Union supplies and giveaways. You don't have to write down every single time that somebody gets a hat or a T-shirt, but they will look at it. Items for supply, for resale or for giveaway purposes. Having a good inventory of that is very, very important. And for Pete's sakes, tell them to stop giving away gift cards. There's just way too much temptation for people to grab an extra gift card or two and use it for personal purposes, and that's going to get you in trouble. Lack of authorization for salaries. I can recall a case of an officer who decided that he wasn't being paid enough, so decided to hire himself as a consultant. There have been a lot of fraud cases OLMS has had where the individuals are being paid far in excess of what they've been authorized. So good policies and procedures for keeping track of how our salaries and expenses authorized. Paid time off is another one. There have been several cases where long-term business managers or officers will retire or be voted out of office and put in a claim for $40,000 or $50,000 of back vacation, claiming they've never been paid a vacation. Having time loss records for that, approval of vacation time, vacation balances, extremely important. And again, these have to show up on the liability side of the balance sheet. And as I mentioned, late filings. This is probably the biggest trigger of all. If a local is habitually 30 or more days late in filing several years in a row, that's going to move you up the target list for CAP audits. Insufficient information on itemization pages, failing to list all officers. These are typical reporting issues and can also trigger a CAP. I'm going to look now real quickly at some of the key performance metrics here. The first one here just shows what the FTE authorization has been for from Congress, and every year the Department of Labor goes before Congress for a budget request, and so OLMS, along with all other DOL agencies, submits a congressional budget justification. I remember doing a number of these, and as you can see here in 2009, when I took over, OLMS was authorized 298 FTEs. That number has significantly declined until it stood at about 196 at the end of the Obama administration, but it continued to drop during the Trump administration. And what's really interesting is it came to an all-time low here of 186 during the Trump administration. I mean, that's down by more than 100 people. And, that is definitely going to affect your ability to investigate cases. Now, keep in mind that OLMS's first priority by law is to investigate complaints of union officer elections. They have a 60-day statutory response period. Their second priority will be criminal cases, and the third priority are audits. So if they don't have the staff, they can't do as many audits. By the way, 208 FTEs authorized in 2023. So there is some sign, although it's a very tentative sign, that maybe their days of staffing curtailments have come to an end. But one of the reasons, of course, is there are fewer unions that are covered by the LMRDA. If you look at the goldenrod here, these are LM3 filers, unions with 10,000 to 250,000 in annual receipts. That's dropped significantly. The smaller unions, the LM4s, which is less than 10,000, has also dropped, but there's been a huge drop in LM2 filers. Mergers, consolidations, unions going out of business. So if you correlate the drop in staffing with the drop in filings, you'll see that there is a fairly close correspondence. Here are the caps, as you can see, and the number of caps conducted, and we hit 754 in 2009, and they continue to fall. And you can see this is plotted against FTEs. And finally, it's right about 250 a year. So maybe 2 caps per investigator is kind of what they try to do a year. The fallout rate, we started tracking it. We got it up to 21%. And it's kind of been hovering around 20%. It's actually dropping off now. So there are fewer caps, as you can see. Last year, 250, the prior year, 221. So a lot fewer caps being conducted. Indictments and convictions is also kind of interesting. These are indictments that from a federal or state court. Convictions, they're falling as well, and you can see how that correlates with the number of investigators that OLMS has. So clearly the agency is smaller than it once was, and is doing fewer convictions, fewer indictments, fewer cap audits. I want to turn real briefly to a subject that's not particularly pleasant, but OLMS has concluded several investigations and criminal cases involving international union staff. And I know many of you work for international unions. I'm not going to mention any names, but I do think it's important because it reminds us that it's very, very important to have those good internal controls and policies and procedures, checks and balances at the international level as well. Here's just a couple cases in point. Here's someone who was sentenced to 15 months in prison with 3 years following of supervisory probation and 200 hours of community service, restitution paid $250,000. This was an investigation run jointly between OLMS and the FBI. So do keep in mind that when OLMS, even if their manpower is stretched, they do have the ability to reach out to the FBI, as well as the Office of the Inspector General at the Department of Labor. And I know when I was director, we used to meet quite regularly with the Washington field office of the FBI. Any organized crime case, we had to turn over to the FBI. This employee submitted false and fraudulent check requests. And this was, again, the third-party vendor scheme, which I'm sure many of you have heard of. They created dummy third-party vendors controlled by confederates of the employee. They submitted bills. The bills were paid to these phony companies, and then the proceeds of the take were split with the confederate and the employee. And again, I cannot stress enough, good internal controls here on, payments to companies. I mean, this should have been caught, quite frankly. It really should have been caught. Why are we doing business with this company? Where's the authorization for this? Where's the warrant? The other problem, of course, is the credit card. This union had an Amazon account with a linked credit card, and this employee just helped themselves, falsified signatures, submitted fraudulent expense vouchers, even altered receipts. So a real bad actor here, and really gave the union a black eye. The restitution, $250,000. I'm sure that the international union here was bonded for at least $500,000. But even during my tenure as director of OLMS, we were seeing cases where the fraud claim exceeded the bonding amount. And that's not good, because you're on your own hook there. Here's another one. And this was a joint OLMS Office of the Inspector General case. Former union employee pled guilty to 1 count of embezzlement, over 500 grand, using a credit card to purchase personal items, pay several shell companies, the same sort of scam as the other one. purchased more than 200,000 in gift cards that she used for personal purchases, and booking personal travel costs for family, friends, and associates through the travel booking platform, and then keeping the money that they paid to a fake company that she created. So once again, I work with Calibre, your CPAs. I mean, this is something you really have to pay close attention to, because I can tell you from personal experience, when I worked for one union, there was a case of embezzlement, and it just gave us a black eye for months and years to come. It hurt us with our organizing. It hurt us with our legislative and political action. It was like we had a black, mark over our heads all the time. So pay attention to this stuff. This is one area too, trustee reports. You may not see this too much in your line of work, but when a international union puts one of its affiliates into trusteeship for a variety of reasons, financial malfeasance, a leadership crisis, there are prescribed reasons for doing so in the Constitution, that are a series of reports, the LM15 and the LM16, that have to be filed. There's an initial report of it. It's quite detailed. Then every 6 months, there's a update that's filed. And then when the trusteeship is over, there's a terminal report that's filed. And while the affiliate is in trusteeship, the parent union has to file an LM2. And even if they're an LM4 filer, a fairly small one, the LM2 form is much, much, much more detailed, and it's filed by the international union and signed by the president. So typically where you might get involved is that you just find out there's a trusteeship, and somebody has to keep track of the books, and those reports have to be filed. If they're not filed within 30 days of imposing a trusteeship, and then there's other time limits, then what happens is you'll get a call from OMS. Your trusteeship report is late. These trusteeship reports are public records, so the public can look at them. Now, the people that most frequently look at them are members of the local union, or in some cases, the officers who were thrown out because of the trusteeship. So oftentimes they have an axe to grind. But you can see the initial report has to have a detailed statement of why the trusteeship and a full account of the assets and liabilities. The semi-annuals, that comes in every 6 months. They have to be filed within 30 days at the end of the 6-month period, and then ongoing. And I can tell you that many unions are very dilatory here, and it's an area that it someday could wind up before congressional oversight. You don't want that kind of headache. So, once there are trusteeships active, you need to keep track of those trusteeship reports. They're quite easy to do, and just to create a spreadsheet, make sure that they're timely filed. Here's the annual report requirement. And then the terminal reports are filed within 90 days after the trusteeship is terminated. These are also submitted electronically, and it discloses the date and the method of terminating the trusteeship, the officers, how they were selected, and it's also included on the LM2. So there's a whole bunch of additional reporting that goes with this, and has to be done very, very, very rigorously. I have 2 more areas that I'd like to talk about with you, and this next one is about grants and transfers to affiliates. Not every international union is doing this, but a number are. The international unions, it's quite well known, are acquiring a lot of assets, a lot of liquid assets, for a variety of reasons. They're doing very well investment-wise. They're acquiring assets of affiliates that have gone out of business, and various and sundry other reasons. And in many cases, they're giving back to their affiliates. Many unions, such as my own, the operating engineers, have a organizing grant program. So these are payments that are in excess of the $10,000 from the international. So that requires an itemization page to be filled out. And it could be, if it's an organizing grant, it's a Schedule 15. If it's to help with lobbying, a Schedule 16. If it's to help rebuild an office, it could be a union administration. It could be a contribution or gift or a grant. So the appropriate itemization page has to be filled out. But what's often less well understood is that the affiliate, if they're an LM2 filer, and most of them are, has to in turn file an other receipts, a Schedule 14 itemization page, if this comes to $10,000 or more, whether it's a single payment or the total payments from the parent union total $10,000 or more for the year. OLMS has a program for cross-matching these. It's not well known, but oftentimes it can open up a request, it can open up an audit, particularly where the local union fails to file an itemization page. So essentially, on the one side of the spreadsheet, you can have the payments, and on the other side of the spreadsheet or ledger, you can have the receipts from the local union or the affiliate. Now, there are going to be some cases where things don't match up. For example, the parent union may have a July 1 through June 30 fiscal, and the affiliate may have a January 1 through December 31. And again, it's cash system, so you book the date of receipt. And that's sometimes does occur. Those can be reconciled by looking at the other bookending year and matching them up. Once again, if the payments exceed $10,000 single payment, then they have to be itemized. And in the itemization page, of course, you'll have the date of the payment. And typically these are handled electronically, ACH, something like that, so that the date of receipt is showing up on the Schedule 14 from the affiliate should pretty closely match with that of the international union. Now, here's the problem. I mean, sometimes the local bookkeeper or accountant may not know the right code words to use, may not realize the payment's coming from the international union. So let's say there was a $65,000 grant that was made to the local, but it doesn't show up at all, or it shows up somewhere else, like payments on behalf of members. That will most likely trigger an audit. Certainly a question from OLMS. So, take some time if you are making payments to your affiliates. What I typically do is I'll look at the international union's LM downloaded electronically, look for all payments to affiliates, and then I make up a master list of that, and then I go and I check out the LM2s for the affiliates. If it's an LM3 or an LM4 filer, there will be no itemization page, so it's very hard to cross-match payments from the parent union to an LM3 or an LM4 filer. So it's typically your LM2 filer. But there are some unions that have 500-600 affiliates. Maybe 300 of them are LM2 filers. So it can be quite a bit of work. But once again, OLMS does cross match the Schedule 14s from the affiliates with the Schedule 15 through 19 itemization pages of the parents, and it's something that you should pay some attention to. So here's just an example. And you can see the itemization pages. These are payments that are made, they're all over the place, but it's an organizing subsidy. And then on here's so this is the Schedule 15. And then here's the other receipts itemization page here. And it shows it's from the international union. So we can literally cross-match these dates here. It shows a total of 274,728, and up here it shows 237,052. So they're not quite in sync. 237 versus lost my mouse here. Versus 274. So they're off a little bit. So we would actually have to just match up those dates and see. Now, here's one here, frontline worker reimbursement received in error. And that's for $7,000. That's not going to account for everything. but it may be, and then here's a reimbursement. This reimbursement may not have been under this grant program. So maybe between those two, you can reconcile the payments from and the payments to. But it's an exercise that you need to do, and it may be necessary for the affiliate to file an amended LM2, because otherwise, when the cross match is done by OLMS, they'll say, well, wait a minute, we're $37,000 off here. You guys need to get to the bottom of this. So I think just getting ahead of the curve is a good thing to do. So start with a list of all of your affiliates who have received organizing grants, subsidies, transfers, et cetera, in the previous fiscal year, and then pull their LM2s, those who do file LM2s, go to the Schedule 14s, that's pretty straightforward, and then do the cross match. And again, if you need any help, give me a shout. I always tell my students that my classes have a lifetime warranty, so I'm happy to help. I'll take just a couple of minutes to close with a tracking system. I know that many of you have this already. In fact, I made it a point to help a number of international unions as part of our voluntary compliance program set up a tracking system. Again, what this is you're going to build a spreadsheet in which you track all of your affiliates. And I helped them set up a tracking system that went back and gathered 5 years worth of filing data, which was very useful. I'm just going to show you the quick and dirty kind here. But if you'd like some help with this, shoot me an email and I'll help you put one together. If you go to the public disclosure website of OLMS, and again, I just warn people when you select LM2 or union search, you have to wait because it has to populate about 30,000 records. So, you say, hey, where do I enter the union? Just be patient, wait for that to happen. And I just picked one union here, and here's all their filings. They're sorted in reverse chronological order, and you can see the filing dates. Now, the reason this is useful, obviously, is that you can see when locals are filing on time and when they're not. And so what you would do here is you can just scroll over here to the right, and you can get receipts, disbursements, assets, and liabilities. Or if you want, you can download the whole report, or you can export it, which is the simple way to do it. The other thing that's useful here is checking to see when they filed their last constitution of bylaws. So this one says the last time they did it was 2005. You may have knowledge that they updated their bylaws in 2015, but according to OLMS, it was 2005. So maybe that's a quick phone call to the IVP or the local union president and say, hey, our records show that you updated your bylaws in 15, but your LM says you didn't do it since 2005. You better get this updated. So this is very, very useful. I just exported all this and then put it into a CSV format. And then I got the spreadsheet here. And all I was tracking were things like their report, the fiscal year. I sorted it this time in correct, ascending order. So there's the filing date, whether it was amended or not, receipts, disbursements, assets, liabilities, and membership. And this is a nice little spreadsheet. It goes all the way to 2022. And you can see, it's a nice report card. How well are they doing? This local, it looks like it's having some difficulties, although its membership is now at 210, and it started off at about 442. This may be a case for an early warning system. And that's how a lot of unions use this. They use this to track on-time filing. Locals that were basically in financial trouble. I mean, they were burning up all their assets and their expenditures were far exceeding their receipts, and their membership was falling. So maybe some kind of early intervention is necessary. It also will help you find which local unions are adequately bonded. You can run a real quick and dirty, bonding test here. Just calculate liquid assets plus receipts times 10% and see what they're bonded at. So there's a lot of uses of this. There's another way to do this. You can do an annual data download. don't really have time to do that this morning or this afternoon, but I could certainly show you how to do it. So why don't we leave this open? If you have questions, shoot me an email. I can show you how to do this, help you set it up. I think it's for a fairly small investment of time. It'll give you a lot more information about your affiliates, their finances, their filing history. Are they likely to need some early intervention? Well, I see that I'm just about out of time here, so I guess I'll finish early because I think there's probably going to be some questions later on. But again, folks, you know, I'm always happy to talk about this. You know, I'm sort of semi-retired now, but you know, I really think this is an important job you all do here, and helping your affiliates and your international comply with the law is really, really important, because it just helps you stay out of trouble. And if you're doing the right thing as far as internal controls and good policies and procedures, you generally don't have to worry. But as I've mentioned, there are some areas to pay attention to: the caps, the trusteeships, so forth and so on. Okay, I'll stop there. Back to you. And I will stop my share.
Great. Thank you so much, John. We very much appreciate you taking the time to be with us today and to share this very valuable information. So thanks again. Our next presenter, James Polis, is an audit partner at Calibre CPA Group, and will be providing an overview of the 2023 Labor Union Survey Report. James brings with him a lot of experience in public accounting, specifically with labor organizations, employee benefit plans, other tax-exempt organizations, covering a wide range of entities like charitable organizations, trade and professional organizations, and other not-for-profits. So welcome, James.
Thank you so much, Jim, and good afternoon, everyone. I'm so happy to be with you here today and really excited to present on the annual labor union report. Now, I did see quite a few familiar names on the registration list, so for those of you that are returning, welcome back. We thank you. This presentation should look relatively familiar to you, but for anyone new, I just wanted to give a brief explanation of what the labor report is. So the labor report is an annual report that we put together, compiled from LM2s filed directly with the DOL on the DOL website. And for the current year, we looked at 2022 filed LM2s. And in doing so, we have extracted 63 organizations that have identified as either national or international labor unions for 2022. We then group those unions into 3 categories for comparability reasons. We have Group A, which are those unions over $100 million in dues and per capita tax. We have Group B, those unions between $20 and $100 million, and Group C, unions less than $20 million. We took all that data, we analyzed and compared it over the previous 2 years today for the presentation. And even though it is all public data, we've decided to keep those names hidden today. Just some quick disclaimers, you will, about the labor report. Remember that some unions may be cash basis or accrual or even a modified cash basis of accounting. So statement A, your assets and liabilities may not be perfectly comparable for all organizations. In addition, there is a potential impact of multi-employer plans versus single employer plans. Certainly a union that has a single employer plan and presents those liabilities on their financial statements may impact the liability in the net asset numbers. Further, one of my least favorite requirements is the requirement to report investments at lower of cost or market, so not necessarily the true fair market value of your investment portfolio. Last but not least, total receipts. Just remember that that is receipts, not necessarily revenue. It does include sales of investments, loans obtained, and collections on behalf of affiliates and from members. Total disbursements in similar fashion does not necessarily equate to total expenses, as it does include purchase of investments, some loan repayments, and a couple other items there, which you can read. Now, I will say we do our best to try and navigate around those pieces at time during our analysis, but just kind of a reminder. So let's jump in. The first thing I typically like to look at here is membership trends. And this is really an encouraging trend in the industry. We've actually seen increases in membership in Group A, as well as Group B. Group C, there was a little bit of an outlier there that is dragging the average down, but absent of that outlier, Group C actually remained pretty level as well. So this kind of breaks the trend here over the last few years. We've seen recently some success in organizing from a lot of the unions we work with and elsewhere out there in the world in the news. Think about some of the larger companies you've heard for which employees have organized recently, such as Amazon, Starbucks, Trader Joe's recently in the last year plus. So really some positive developments there in the union world and the organizing world, but of course, some more work to be done. So let's take a look at how maybe some of the per capita tax and the dues are reflective of some of those membership trends. So here you can see increases in all three categories as well, of course, the all group average. So Group A actually had the most significant positive change in per capita tax. Again, a very good trend to see. And not only is this a factor of the membership trends that we saw on the prior slide, but also a result of many dues increases we've seen from our clients and other organizations as they kind of look to hedge risk against the historical membership trends, as well as some various social economic pressures. All right, so modified disbursements. Modified disbursements is our best calculation or best estimate of what true expenses are. So we take total disbursements and we exclude certain items being classified in there, such as investment, fixed asset purchases, loans made, monies dispersed on behalf of members or affiliates, and we're left with modified disbursements. For this slide, I'd like to focus all the way to the right here on the all group average. And with the all group average, we saw a pretty significant increase of about 16%, just north of 16% in modified disbursements. A lot of factors here, but most significantly would likely be an increase in travel expenditures, expenses for meetings, conferences, conventions as organizations have gotten back to their more regular programming post-pandemic, which should not be a surprise to anyone. So that's definitely a large factor here. But also don't discount the impact of inflation. We've seen inflation of 6.5%, 7%, even up to 8%, depending on what the metrics that are being used. So that is certainly a factor here, as well as the cost of various services, service providers, supplies, et cetera, have all increased. So all those things need to be considered when evaluating disbursements, and particularly moving forward when you're looking at your budgeting and forecasting. Net assets. So here's another pretty solid trend. We saw net assets for all groups remain pretty consistent with the prior years. And this one definitely surprised me a little bit. We saw just slight increases in revenue, very significant increases in disbursements. And those two things combined with a lot of volatility in the investment markets, I was kind of expecting to not see as much consistency. So really good to see that all the unions we work with and many other unions have remained strong in relation to their financial position. All right, so I wanted to drill down into that net assets number just a bit deeper this year and do a little bit of a deep dive. So we'll have investments and US Treasuries on this slide, and then we'll see liabilities on the next slide. But for investments, we of course saw a bit of a market correction in 2022, if you will, to say the least. And that's kind of what you're seeing here primarily. Now, keep in mind the requirement to report investments at the lower of cost or market value is likely watering down this number a little bit. So certainly these numbers, particularly the all group average, decreased as we expected, although not quite as much as we were expecting, which is great to see. And moving on to liabilities, this is where we saw even a more significant change for the 2022 forms, is a decrease in that liability number. The all group average, all the way to the right of the slides here, decreased close to 7%, which is pretty significant decrease. For those unions presenting a benefit obligation for one or multiple of their single employer plans. That can certainly be a factor here, as those increasing discount rates drove down the benefit obligations. But what we did see, and we looked a little bit further, is there was also just a continued pay down of debt and other liabilities, as well as a decrease in organizations entering into new loans, into new debt arrangements, as interest rates have, of course, risen, and the appetite certainly has been suppressed there a little bit. So overall, a fairly significant decrease, which is helping kind of keep that net asset number in a positive light. All right, so taking a step back here, we have a poll. So please, for those of you needing to get CPE, please select the poll. But taking a step back here a couple slides ago and taking a look at that total net asset number, and we looked at it in relation to the modified disbursements and how that compared or calculated to the organization's operating reserves. You know, how many months of expenses, how many months of reserves that the union were holding. And as you might expect, with flat net asset numbers and a large increase in disbursements, along with some of the other factors we had previously discussed, the reserves decreased as well, right? So we saw pretty big increases in the prior year, but kind of a correction and a decrease in 2022. The good news, though, is that overall, all three categories still very strong. You know, each group, Group A, Group B, and Group C, all of them above 24 months, so above 2 years, which is a very good place to be, a very appropriate place to be in order for you and your members to feel good about the financial position of your organization, so that you can focus on your programming and focus on your mission. All right, moving on, that slide should update in just a second, but switching gears a bit, we did have some responses to selected questions 10 through 17 that we wanted to look at. Very consistent here. If you were to compare these against prior years, we always like to see that all the unions 100% across the board did have a financial statement audit, which of course is a good kind of control for your organization. The only kind of high level takeaway here that I saw was that a pretty significant decrease in the contingent liabilities number. That certainly decreased overall, which would kind of align to what we saw on the trend of overall liabilities just a couple slides back. All right, that slide should update in just a second, but we wanted to take a look at chart 2, which is the bonding amount. And John Lund spoke on this a little bit, but on the DOL website, you actually can find a computation worksheet that suggests a bonding amount based on your own specific organization's activities. And the reason I like to bring this up is that based on that calculation, a lot of the unions we work with actually fall pretty short to that calculation. And typically, we don't see much movement in these policies from year to year, even with things considering like the inflationary environment and just more money moving through an organization as it grows. These tend to remain pretty stagnant. Now, I say that is typical, although we did see, as you can see here, a pretty big jump in Group A for 2022 compared to 2021, which is great to see, meaning that an organization is going through that process to evaluate their bonding amount. So my challenge to everyone is just to kind of keep this in mind when thinking about protecting your organization. I would encourage most unions to at least evaluate this coverage every 2 to 3 years, just as you would any other insurance policy, making sure that you're comfortable with your coverages and comfortable with hedging your risk. Okay, functional expense breakdown. You can see here Group A, the comparison for 2020, 2021, and 2022. We have Group B and Group C on the next couple slides. Really not much movement in the Group A percentages, as you can see. These have typically remained very consistent over the years. Remember, Group A is kind of those large dollar unions with an average of over $200 million in disbursements. So certainly would take a significant change in programming or a significant change in the functional allocation of salaries or other expenses to change these percentages by a wide margin. B, we saw a little more movement. We saw a slight decrease in representational activities, a slight increase in some of the union administration activities. That's likely these organizations getting back to some more governance activities, some conventions, some meetings, conferences post-COVID, which a lot of the times do get reported on Schedule 19. Group C, much of the same, similar trend to Group B as far as representational and union admin activities. Elsewhere, your political, your contributions, your overhead really remain pretty consistent for all three groups. All right, chart 8 shows the payments to officers, employees, and benefits as a percentage of total functional expenses. At first glance, this might seem a bit surprising, but think back to what we talked about a few minutes ago when looking at the modified disbursement trends. Overall disbursements, overall functional expenses increased significantly as largely as a result of the increased travel, increased meeting, conferences, expenses as a result of COVID recovery. And that's really what the impact you're seeing here. The takeaway is that personnel costs did in fact increase, which is to be expected. They just didn't increase quite as much as the functional expenses in total. Chart 13, we took a look at average officer's salary, remained pretty consistent with the past few years with some variations in each group. Group C, a little bit of an outlier in 2021, which was raising that number. But overall, if you were to look at the all group average, you would see just a slight decrease, but overall pretty flat as far as the average officer salary. All right, last couple slides here. Chart 14, we took a look at the average employee disbursement. Now, keep in mind, this is the employee disbursement that's reported on Schedule 12. So it includes not only employees' wages, but also potential disbursements for official business. So the average employee disbursement did increase in each group. And the overall, of course, just about 3% for Group A, 4% for Group B, and north of 7% for Group C. So overall, the average increases were around 5%. Solid increases, pretty much right in line with our expectations when looking at employee disbursements, employee compensation, and an increase of that official business disbursements. All right, last slide. Here's a trend that we always like to look at, which is benefits costs. This is a trend that actually kind of surprised me for 2022. I would have expected benefit costs to continue the historical trend of increasing, but we actually saw it pretty flat. And in fact, the all group average actually decreased slightly, about 2%, which is a good thing to be able to control those costs, of course, but certainly would keep an eye on this trend, particularly seen in the economic and the inflationary environment we're seeing today. Certainly would expect this to continue the historical trend of increasing in the future. And with that, that's really it. That concludes my portion of the conference today. Thank you so much for listening. Hopefully, I left you with one or two takeaways or trends to keep your eyes on as you look to help your organizations and the industry, plan for the future.
Great. Thank you very much, James. Now we're proud to introduce our final speaker, Kristen Jacqueline. Kristen's the director in our tax department at Calibre CPA Group, and we'll be sharing tax updates that could be very important to your organization. Through her career, Kristen has focused on auditing and ensuring compliance with regulatory tax requirements for labor unions, employee benefit plans, associations, and other not-for-profit organizations. She plays an important role within the firm, collaborates with other team members to establish and enhance processes and procedures in various programs, Her responsibilities also include all tax-related aspects of performing an engagement, planning it, supervising it, and the completion of the required tax and informational returns. So welcome, Kristen.
Thank you, Jim. Happy to be here again this year. Thank you for everyone to stay to the end to listen to this wonderful tax update. So just a few updates and reminders to start us off. During COVID, the IRS relaxed their e-signature rules for various returns, a whole list of them. At the moment, the allowance for the 990 to be signed electronically by the officer is set to expire in October. They are working to extend that, not only temporarily, but permanently, that hopefully we can then implement a process for that to be done electronically on a permanent basis through the software, and that will be a lot easier. There are a few forms, and I actually missed one on here, but both the power of attorney and the form 5500 both still need a wet signature. Now the 2848 is specific to it being wet. I will say the 5500 says manual. So I have personally, written out my signature and scanned it into Adobe, and I would call that manual as well. But using something, where you type it in and it just gives you a nice script font, that's not gonna work. So just a reminder on that, because it takes time, especially even if I forget and we have to go back and forth a little bit. So back several years ago, during 2020, the IRS had accidentally released some returns to the public that should not have been released. Since then, the returns that are typically posted on their website or on GuideStar or ProPublica have not been released. As of about a month ago, they have been released for public posting. So they are now, the returns filed 2020 through current are on GuideStar or ProPublica or any of those other websites. I just checked during this presentation, and they're still not posted on the IRS's website. So I'm not sure what's happening there, but they are back out there on GuideStar at this point. So no changes really to the Form 990 for 2022, or that I've heard so far for 2023. But there are some changes to the 5500 that I want to just real quick talk about. For 2022, it's not a lot. There's some new codes. Schedule R requires, if you're required to complete Part 5, line 13 for the participating employers, the rule used to just be any employer over 5% of the total contributions. It's now you need to report the top 10 highest contributors, whether they're over that 5% threshold or not. So that's two small changes for 2022. 2023, we saw, a lot more changes with the Secure Act. I think the most relevant, I don't have them all here. A lot of them are only apply to certain plans that I did not feel was relevant here. But the big few, there's a new admin fee breakout on Schedule H that will break down audit fees, bank fees, actuarial, legal, salaries, trustee fees, so anything paid to the trustee, and then other expenses. I feel a lot of plans have that as a supplemental schedule in the audit, so I don't think that'll be a huge change. There will be some changes for the Schedule MB, SB, and a few for the Schedule R. Nothing major, it's just intended to kind of increase transparency on that, and we'll let the actuaries worry about that. There is a new schedule for multiple, so MEPs, multiple employer pension plans, where you need to list out both what type of plan it is and then the list of employers as well. So I think one of the biggest hot topics for the 5,500 for 2023 is this new group of plans. So it's a collection of defined contribution plans, and you will now have the option to file a consolidated 5,500 for this collection of plans. The thought was that if these plans are all being administrated the same, that it's actually less of an administrative burden to group them all into one 5,500. I don't know if I agree with that. I think it depends on how the plan is set up. But the definition of how you can be in a collection of defined, a group of a plan, you have to have the same trustee. The fiduciary needs to be the same. The plan administrator, they need to have the same plan year, and the participants need to have the same investment options. So if you're basically just have plans that are, you have your 403B and you have various plans, then you can group those together and file a Form 5,500. I think there will be more coming out on that. There's not a ton out at the moment on how that's going to work or who that would really benefit, but would say stay tuned for that. As we're coming up, it's that time again where we've seen a lot more activity with the PAC funds, contributions coming in, going out. Just a quick reminder to use your PAC funds as they were intended. Be careful where you're cutting checks out of for either direct contributions or even your indirect expenditures. It would be great if you have those PAC funds set up, use them appropriately. Direct contributions made out of your PAC, run your independent expenditures through your super PAC. We avoid any 1120 POL taxability issues, and life will be great. In good news, the 1120 POL will be available for e-filing in 2023. So if you have not filed an 1120 POL in the past and you think that you will need to file that for 2023, please let us know. We want to try, it's great that it's going to be e-file, but it never goes smoothly. So I'd like to get any kind of kinks worked out. If we need to call the IRS, make sure people are listed in the database appropriately. We want to get that taken care of ahead of time and not worry about it at the deadline. And just a quick reminder too, on the 1120 POL, if your PAC fund has more than $100 of non-exempt income, then you will be required to file and pay tax on that. That's typically going to be your interest income. So I know a lot of funds have had some significant contributions as we're heading into the next election season, and the interest rates going up, and they're going to end up with some taxable income. So just something to keep in mind. And one more thing, we're nearing the end here with the COVID relief. Specifically, I'm thinking the employee retention credit. If you're kind of at the end of where you can amend to where most organizations were eligible for it. But I just want to mention, just in case, the beginning of the year, there was this huge push where everyone was, myself included, emails, letters on these firms that were advertising that they could help you apply for the employee retention credit. And that the rules had been relaxed and it wasn't, as strict as everybody thought it was. That is not true. The rules did not change. It's not relaxed. The IRS even issued a notice saying, be careful of these scams. So I think we're about done with it. So hopefully it'll just go away and we don't have to worry about it. But if you do get that letter from a company and you're not sure, reach out to us, as many of you already have. We're happy to jump on a call. But that should be coming to an end. So the next big thing coming out of the Taxpayer First Act is expanded electronic filing requirements. This will begin in 2024, but for the 2023 year. This applies to all types of returns. Well, I have a little table on the next slide. In the past, the threshold was 250 returns, and that if you had 250 more, you had to electronically file. They've reduced the threshold to 10. The other thing they did was they now require an aggregation of all applicable returns. So in the past, if you had 200 W-2s and 200 1099s, you weren't required to electronically file either groups of returns. But under the new rules, you will now be required to file those electronically. You need to add them together to figure out to get over 10. And of course, they didn't make adding to 10 simple. What returns you count in order to get to 10 is different on the type of return that you're looking at. Keeps me employed, I guess. On top of that, if you are part of a controlled or an affiliated service group, you need to aggregate the number of forms from all entities. The easiest example of that is going to be your employee benefit plan. That plan, in order to count to 10 to determine whether they need to file 1099s or 1099Rs, W-2s electronically, they need to count the forms of the plan sponsor. So what is a controlled organization? It is actually very similar to the definition for Schedule R of a related organization, thankfully. So that should be fairly simple for us to look at and figure out. The threshold, though, is 80% of the board instead of 51 and greater. So if 80% of your board is the same, you're considered in a controlled relationship. If another related entity has the power to appoint 80% of your board, you're in a controlled relationship. So I feel that should be pretty straightforward definition. That shouldn't be as difficult. Where it becomes a little more cloudy as the affiliated service group. And if someone really is bored and wants to fall asleep and look this up, the definition is under code section 414, B for the controlled, and then M for the affiliated group. I'm giving you that because it's not straightforward. And it's a little difficult to kind of, you would need to do an analysis for each thing. I'm thinking for our particular clients, for labor union clients, this may apply where you have an employee benefit plan and you have one entity that does the management services for all those plans. The easiest way, if more than 50% of gross receipts of that management services entity is for those services and not some other purpose, then you're in an affiliated group. There are pages of other qualifications and definitions that we would want to look at. So I would say if you think that you may be in that situation and you are paper filing returns that you may need to electronically file, reach out. We can, walk through it with you and hopefully get a better sense of what you're looking at. Now, because this is, potentially going to have a pretty big impact for smaller organizations, smaller companies, the IRS did release a new e-filing system through the IRS for 1099s. The link is here. I will say I don't think very many people have used it yet. So I can't tell you it's great. It's not a problem. I will say they've done a decent job with the 990Ns that are now through them. So, I mean, hopefully it's not horrible. Otherwise, organizations are going to have to find an outside vendor to help them file these returns. So what I did on the next, so we have our first polling question, next one for mine. So I'm curious to what extent your organization already electronically files returns. I know there are a few of you that still love paper, so just curious on that. I put together this chart. Hopefully this is helpful. I found it a little difficult to follow the rules otherwise on how to count to 10, basically. Most returns are going to start with the group of information returns. So that's the one at the top. You would count all of the returns in the second column. And if you are over 10, you are required to file any of these forms electronically. So that includes, I know a lot of folks are filing the Affordable Care Act forms on paper. Those will, potentially are going to now need to be done electronically. This would include your 1099-Rs, and as well as both the miscellaneous and the NEC, your W-2s, W-2Gs. This does not include, it specifically excludes though the 8955 SSA. So that's good. I did put on here the corporate returns, partnership returns, just as some of you have taxable entities. Again, everything starts with the information returns. Income tax returns does include the 990T. But if you notice in the information return section, it does not count the 990. So when you're counting to 10, you do not need to include the 990. But if you file a 990T, that is included in your count to 10 for a different return. Now, both the series 5500 and the 990, when 990 is 100, everybody needs to be electronically filing at this point. So in terms of it being included in this act, it's not, because it was already required to be electronically filed. And same with the 5500. I just put, it may impact some small employers that are still currently paper filing. It probably does not affect very many of you on this call. And then the 4720 next will be able to electronically file next year, as well as the 1120 POL. So hopefully this table is helpful. There are, you really have to dig into the code. So if you are unsure, reach out, we can help you. Honestly, my best advice would be is to just electronically file whatever you can. And I'm assuming the bigger organizations, this will not be an issue, but maybe some of the smaller locals, it may be a problem. Okay, I talked about this last year, but it keeps coming up, so I just wanted to bring it up again. You are required to update first the IRS and then a state if you're required to have an account or be registered with the state. So updating the responsible party, your address, all gets done on the form 8822B. There is a behind the scenes, so it's not on the face of the 990, but in the software this year, there is a question before I can electronically file. I have to check a box, yes or no, if your information is up to date with the IRS. It's not on the face of the return, but it's in the electronic filing. So I hope that means that maybe they're moving that we can electronically file this form and we won't have to mail it, but right now we still have to mail the form. And also for DC, you would update that information on your mytax.dc.gov account. I just had a client recently, I was trying to help them with a few things, and DC wouldn't even talk to me because I had the wrong officer. I had the current officer, they had the old officer. So please make sure that gets updated. For Maryland, and not all of you will are required to be registered with Maryland, but if you are, it's done through the Form 1 each year. And just real quick, I wanted to kind of give some trade secrets, I guess, a little bit here. Their IRS website is actually a wealth of information for nonprofit organizations. You can typically view the 990s, although, as I said earlier, they're not all out there at the moment. Determination letters for the last, I think it's like 6 to 10 years are out there. And it also lets you know if someone's been automatically revoked. Now, they are a little behind in the updating of the automatic revocations. COVID definitely took a hit there, but I just want to point this out. It's a huge help. I think I get a little too much credit sometimes on some help that I give some of our clients, but the information's out there, and there's some training videos as well as some short answer, question and answer that they have out there, that it's a huge help. So that's it for my presentation. Thank you for staying to the end, and I will give it back to Jim for some question and answer.
Okay, thank you very much, Kristen. Well, that concludes the formal presentations from our speakers. And now we'll move into our question and answer session. And I see we have 5 questions that came in. I'll pull a question, and any one of our speakers, please feel free to offer any insight. And it looks like they kind of came in the order of the presentation. So the first question, any advice on the implementation issues relating to the lease standard? So I'm thinking, Mary Margaret, that might be for you.
Nobody else wants to answer the accounting and auditing questions.
I should assume that, but I could be wrong.
I kind of alluded to this during the presentation, but we've been through 6 months now, basically, of implementation and assisting clients with this for their December 31st, 2022 financial statements, and a few that did an early implementation, back in 2020 and 2021. And I think it would just be to make sure that you really have captured all of the leases. Like, one of the things that I've noticed when looking at other invoices as we're doing our audit testing is that there are some other smaller leases, like for computer equipment or something that's running through a larger IT contract. And so just making sure that you're picking those up. It could well be that once you make the determination that it is a lease, that when you do the calculation, it's not material to the financial statements, but you would want to make sure that you've at least looked at it. And then the other thing would be is just to make sure that you are using the correct interest rate to perform the calculation on determining the lease liability, which in turn is going to help you figure out what the right of use asset is. If you are using the risk-free rate of return relative to the beginning of 2022, the date of implementation or adoption of the new standard, that rate's going to be lower than it would be if you actually had an implicit rate in the lease, likely, or you were using the incremental borrowing rate if the organization has a line of credit or a mortgage or something like that. So the larger the rate, actually, the smaller your lease liability and right of use asset is going to be. So those are the 2 things I think that are kind of the biggest hiccups I've seen as we've been implementing. Thanks, Jim.
Okay, thank you. The next question is, can you please elaborate on what types of fraud training organizations are doing internally?
Sorry, I had to unmute myself. I'm going to assume that's for me. Kind of went through this in the presentation some as well. The types of fraud training, I think right now, are mostly centered around the training for the financial staff when it comes to disbursement training. So whether it be for fraudulent requests for ACHs, fraudulent requests for checks, things of that nature, definitely trying to raise the level of skepticism among the financial staff that are responsible for those payments, making sure that they are attuned to the continual improvement of the schemes that are coming through in emails. They're no longer nearly as obvious as they used to be. And unfortunately, it is really not unusual now for me to get contacted, once a week, once every 2 weeks by somebody, normally not a client, normally an affiliate, who has in some way been negatively impacted. So again, we really advise just to keep raising that level of training for the financial staff to be aware of these, schemes centered around getting unauthorized disbursements.
Hey, thanks, Art. John, thanks for staying with us here. I think this question relates to your presentation. What will OMS do if trusteeship reports are not filed on time?
Well, you'll get a phone call from either the district or the national office, and they'll say basically, where's your report? They have a provision in the law, section 209, which is a criminal penalty, and 210, which is a civil penalty, but they never used it. So I think, realistically speaking, are you going to be brought before a judge in federal court for not filing it? I don't think there's a very great likelihood of that happening, but they will bug you about it, and they won't stop just with the financial officer in question. They'll go right to the top. And if it's an affiliate that hasn't filed a report, they'll believe me, they can be very, very persistent.
Yeah, definitely. Thank you. The next question looks like it relates to the labor survey that we talked about, that James spoke about. What would you say is the trend that sticks out the most?
That's a good question, and it's a tough question. I think anyone that would look at the data might come away with their own trend. But if I were to come up with just kind of maybe not a specific trend, but a high level takeaway of a few trends, the one thing that has stood out to me in doing this report and this presentation over the past few years probably is the ability that all the national and internationals have had in handling adversity and change, and making sure that they are remaining financially sound. Think about all the changes and the challenges that the world has faced over the past few years with the onset of COVID, industries being turned upside down, the markets crashing, and even more recently in 2022, a lot of market volatility, impact of significant inflation, increased interest rates, the whole gambit. And yet the labor industry as a group has really done pretty well. And I think that's something to be really proud of.
Yep, great points. Thanks, James. And lastly, it looks like a tax question under the new electronic filing rules. How do you handle amended returns?
Sure, Jim. So if you were required to electronically file the type of return initially, then you will need to electronically file the amended return as well.
Okay, great. Well, that wraps up our conference for today. We want to thank you very much for joining us, and hope you found the conference informative and helpful. You will receive an email with instructions on accessing the program materials and also requesting the 3 continuing professional education credits, should you want those. We hope you have a wonderful rest of the afternoon and look forward to joining you at this conference again next year. Take care, everyone.